Welcome to the American Institute of Cloud Auditors YouTube channel. I'm your host, Robert Llewellyn-Kilby. In this presentation, I will explain the Sarbanes-Oxley or SOX Act of the U.S. Congress. I will also talk about the important role the Public Companies Accounting Oversight Board, or the PCAOB, plays in the enforcement of the SOX Act. And finally, I will state why AICA Sky Blue books are designed to mitigate the risk of non-compliance with the SOX Act, which is federal law that relates to public company financial reporting. The SOX Act is. But first, the contents of this presentation. We'll begin with a SOX overview. We'll talk about Enron debacle and why the U.S. Congress enacted the SOX Sarbanes-Oxley laws. We'll talk about Arthur Andersen's role and downfall leading to the Final Four accounting firms. We'll talk about SOX Section 302. We'll talk about SOX Section 404. And we'll talk about the role of the Public Companies Accounting Oversight Board, again, the PCAOB and other regulators of the profession. 2002 Sarbanes-Oxley Act, or SOX Act of the U.S. Congress. It relates to the standard for internal control over financial reporting, which is IT auditing standards. The 2002 Sarbanes-Oxley Act of the U.S. Congress implements regulations on publicly traded companies and the accounting firms that audit publicly traded companies. Publicly traded company are a company that trade their stock on the National Stock Exchange. SOX was enacted to improve the accuracy and reliability of corporate disclosure in financial statements and to protect investors from fraudulent accounting practices. Prior to the U.S. Congress enactment of SOX, the accounting profession in the U.S. was self-regulated by the American Institute of Certified Public Accounting, AICPA. At the time, AICPA management team comprised principally of the Big Five accounting firm managers. The SOX Act was precipitated by large-scale financial shenanigans at Enron Corporation. There was a $75 to $100 billion revenue company at the time, Enron was. Two of Enron top executives, Jeffrey Skilling and Kenneth Lay, were convicted and went to jail for knowingly publishing falsified financial statements. As Enron investigation was ongoing, the tentacles of the investigation extended to Chief Executive Bernard Ebbers of WorldCom Inc. and former Health South Corporate Chief Executive Officer Richard Scrochy were also investigated for similar financial shenanigans. Both of these executives admitted to the fact that the illegal financial act were perpetrated at their respective companies. Ebbers was convicted and Scrochy was acquitted. Key dates in Enron's debacle. On October 8, 2001, Enron reported a large third quarter loss that sparked a crisis in the financial market around the world. On December 2, 2001, Enron filed for bankruptcy. On February 18, 2004, former Enron president Jeffrey Skilling was indicted. On July 7, 2004, former Enron chairman Kenneth Lay was indicted. On January 30, 2006, trials of Skilling and Lay began in Houston, Texas, courtesy of Wall Street Journal. Arthur Andersen's role and the downfall leading to the Final Four. One of the world's largest accounting firm at the time was Arthur Andersen, and Arthur Andersen was Enron external auditor or independent auditor. Arthur Andersen was found guilty of shredding evidence and lost its license to engage in public accounting practice in the U.S. Hundreds of civil suits were filed by shareholders against both Enron and Andersen. The Sarbanes-Oxley Act of 2002 imposes harsh penalty for destroying, altering, or fabricating financial records. Courtesy Encyclopedia Britannica. So the Sarbanes-Oxley Act, or SOX, has two major provisions, Section 302 and Section 404. Section 302 requirement, SOX Section 302 requirement. The signing officer, which is the CEO or CFO of the publicly traded company, must review the internal control over financial reporting report. Based on the officer's knowledge, the ICFR report should state that the report does not contain any untrue statement of a material fact or omit a material fact that would make the statement misleading. Based on the officer's knowledge, financial statement and other financial information included in the report should fairly present in all material respect the financial condition and results of operation of the issuer as of and for the period presented in the report. The signing officer's responsibility include establishing and maintaining internal control over financial reporting, ICFR, designing the internal control to ensure that material information relating to the issuer and its consolidated subsidiary is made known to the officer by others within those entities, particularly during the period in which the periodic report are being prepared. Section 302 requirement continues. They are also responsible for evaluating the effectiveness of the issuer's internal control as of a date within 90 days prior to the report. And finally, presenting in the report their conclusion about the effectiveness of the internal control based on the evaluation as of that date. The signing officer have to also disclose to the issuer, auditor, and the audit committee of the board in person in fulfillment of these equivalent functions all significant deficiencies in the design or operation of the internal control which could adversely affect the issuer's ability to record, process, summarize, report financial data, and have identified the issuer's auditors, and I have identified for the issuer's auditor any material weakness in internal control. So which means that the company executives are supposed to disclose all weaknesses in internal control. They have to identify and report it to the auditor. And any fraud, whether or not material, that involve management or other employees who have a significant role in the issuer's internal control, should be disclosed to the auditors as well. The signing officers have indicated in the report whether or not there were significant changes in the internal control in other factors that could significantly affect the internal control over the internal control subsequently to the date of the evaluation, including any corrective action with regards to significant deficiencies and material weakness. So what that means is any type of changes that were made to the internal control system prior to during the prior period should be reported to the auditors in that report. Section 404, which is the second provision within the Sarbanes-Oxley Act, requires that the management team should state the responsibility of management for establishing and maintaining an adequate internal control structure and procedures for financial reporting. It should also contain an assessment as of the end of the most recent fiscal year of the issuer being the broker dealers and share and the stock issuers, of any effectiveness of the internal control and procedures of the issuer for financial reporting. It should contain a risk assessment of the effectiveness. It should talk about the internal control evaluation and reporting with respect to the internal control assessment required by that subsection. Each registered accounting firm that prepares or issues the audit report for the issuer should attest to and report on the assessment made by the management of the issuer. The issuer being the person the company that's issuing stocks or bonds. An attestation made under this subsection shall be made in accordance with the standard for attestation services issued and adopted by the board, which is the PCOB, and the PCOB has adopted the American Institute of Certified Public Accounting Standards for attestation engagement. Attestation engagement is mainly audit engagement. and shall not be subjected to any separate engagement. So in summary, Section 302 and Section 404 require management to gain an understanding of the flow of transactions, including IT aspects, in sufficient detail to identify points at which misstatements could arise. It should evaluate the company's entity-level controls, which corresponds to the components of the COSO framework. We'll discuss the COSO framework in another presentation. COSO is the Committee of Sponsoring Organizations. And then they should perform fraud risk assessment. They should evaluate controls designed to prevent or detect fraud, including management override of controls. They should evaluate controls over the period end financial reporting process. It should scale the assessment based on the size and complexity of the company. So the smaller the company, the smaller the scale of assessment, risk assessment that should be conducted. It should rely on management's work based on factors such as competencies, objectivities, and risk. And it should conclude on the adequacy of internal control over financial reporting. So the role of the Public Companies Oversight Board with respect to the Sarbanes-Oxley Act. The PCOB oversees audit of public companies and SEC, Security Exchange Register of brokers and dealers, in order to protect the investors and further the public interest in the preparation of informative, accurate, and independent audit report. The PCOB oversight activities include standard setting, inspection, enforcement, international cooperation, and registration. International cooperation because the accounting and other entities or subsidiary of an issuer or a public company could reside overseas, and they have to cooperate based on their accounting and reporting standards. The PCOB seeks to carry out this authority by being the trusted leader that promotes high quality auditing through forward-looking, responsive, and innovative oversight. So the AICA Sky Blue books are going to assist in this particular process in terms of being innovative and resulting in delivering high quality auditing standards. The board establishes and amends auditing and related professional standards for registered accounting firms to follow in the preparation of audit reports for public companies, other issuers, and brokers and dealers. Inspection. The PCOB inspects registered public accounting firms to assess compliance with the Sarbanes-Oxley Act and the rules of the board, the rules of the Security Exchange Commission, SEC, and professional standards in connection with the firm's performance of audits, issuance of audit reports, and related matter involving U.S. public companies, issuer, brokers, and dealers. So as you will see in another presentation, we talked about assisting the firms that audit these public companies. They have deficiency in the internal control method of auditing, and AICA has developed methodology to improve those methods and give them the requisite skills and competency to carry out their PCOB mandated duty. Thanks again for listening, and hope you enjoyed this presentation.